Welcome back to the channel for the 5-Minute Wednesday. Look at the calendar today, it's Cinco de Mayo. Now, financial markets don't care about Cinco de Mayo, but they care about the fact that we're in the month of May. Sell in May and go away is the famous financial mantra simply because historically the month of May has always been extremely weak for the stock market. This is the typical month when these big, deep, meaningful market corrections tend to happen. Today I want to show you 10 charts that will help you save money and avoid making losses. Most of the charts I want to show you today come from a Bank of America report that was just published that has about 70 to 80 charts, and they kind of fall in different categories. One is market sentiment, market valuations, a third one that's called Outsize Returns, and fourth that's called risk appetite. So on the first category, market sentiment, I want to show you this chart here that shows what they call a sell side indicator, which historically has been a very good contrarian indicator of what's happening in the market. So you see the chart is kind of split in three different territories, let's call it. Anything that's above the red line is showing a market environment where there is extreme bullishness, which ultimately leads to, sell-offs in stock when people are obviously the whole market is too bullish. And then anything that's below the green line is an extreme bearish territory, which ultimately leads to an environment that's bullish for stocks as they recover from sell-offs. So if you look all the way to the right, we are approaching this red line, which is a sell signal for the stocks. And the last time we were here at these levels was in May 2007. That's 13 years ago, just before the global financial crisis was starting. And you obviously see on this chart that huge sell-off from 2007 all the way to March 2009, where we bottomed at 666 on the S&P 500. On the second category, on the valuation metric, I want to show you three charts here from this report. Because as an investor, you always want to ask yourself, how long is this going to last if the market's doing so well? And how does it compare to history and to other markets? Looking at this chart here, kind of drawing parallels between today and the tech bubble back in 2000, 2001, you see a measure of the S&P 500 forward price to earnings ratio. And at this point, we are 40% above the long-term average. So we're somewhere around 22 back in 2000, 2001, before the tech bubble burst, and obviously we had a giant sell-off. We were around 24, 25. So certainly we are getting up there if you want to measure this against what historically has been the norm and the long-term average. The second chart I want to show you here is what they call the valuation dispersion of returns of the S&P 500. So if you look again here, we are way above the long-term median, and the estimates are that if we were only to return to the historical median, that's representing about 8% sell-off in the S&P 500 that we would have to see. And finally, on this third chart here, that shows you how expensive the US market is relative to the rest of the world. And again, you see this has been a giant, super strong run over the last 5 or 6 years for the US markets, as clearly they outperform the rest of the world. But again, on a relative basis, as an investor, as a money allocator, when you think about how big fund managers allocate money, at some point people will allocate money away from the US markets back to Asia, emerging markets, and Europe. And this chart really shows you how expensive at this point the US markets are. This next chart I'm putting on the screen is, I think, my favorite chart from this whole report. And it really shows you what happens when you have a period of outsized returns. The last year has been completely crazy in terms of returns, and what happens usually afterwards. So when you look to the left here, you see the 12-month return as of March 2021. So the 12 months prior return was 54%, which is the highest return since 1936. And it's the third highest ever. So this is absolutely phenomenal in terms of what kind of returns we have seen in the S&P 500 over the last 12 months to March 2021. And you see, when you look to the right side, you see the drawdown in 2020, right? That big sell-off when COVID-19 hit. That really wasn't all that big in terms of, when you compare it to other moments in history. But the recovery certainly was, an outsized recovery, an outsized return when you compare it on a historical basis. And for the lovers of statistics, this was a 2.3 standard deviation above the average. Now, that maybe doesn't mean too much, but a move of this magnitude only happened 4 other times since 1928. And 3 times out of 4, so 75% of the time, the market registered losses in the 12 months that followed these outsized returns. So statistically, there's 2 points I want to kind of take away from this chart here. Number one, it's unlikely we'll ever see this kind of return on a 12-month basis in our lifetime, right? Because looking back in 70, 80 years or 90 years almost. This only happened 3 times where we had higher returns, but also in terms of what's going to happen going forward for the 12 months from now, statistically, the market's going to sell off. And finally, the last set of charts that I want to show you about fall under the category of elevated risk appetite, right? What investors really are expecting when they're investing in the stock market today. So looking at this first chart here that shows you the ERP, which stands for equity risk premium. So just a quick side note here in plain English, equity risk premium effectively is the expected rate of return that an investor expects by investing in equities. And that rate of return is what they expect above the risk-free rate. So let's say the US Treasuries are a risk-free rate investment. And if you invest in equities, you are expecting to be paid above that risk-free rate for the risk you're taking by investing in a company, right? That there is a certain risk. So when you look at this chart here, it shows you that this premium that investors expect when they invest in equities is now below 400 basis points, which is only the 3rd time that this happened since the financial crisis. And the 2 instances where it happened previously was in January 2018 and in September 2018. And in both instances, the S&P 500 sold off shortly thereafter. In January 2018, the sell-off was, right after that was 10%. And after the September 2018 level, when we hit this, the ERP was below 400 basis points, the market sold off by 20%. You may remember the end of the year 2018, there was a huge sell-off, very quick and very aggressive, by 20% in the S&P 500. So again, we're approaching these levels here in terms of valuation and risk appetite, what investors are expecting when they're investing in the stock market. This level is again another kind of warning signal that I really pay attention to, simply because of what we have seen in 2018 when we hit similar levels. So again, I'm not necessarily saying and calling the top of the bubble here, but again, we are looking at a set of charts that kind of point to excessive risk taking and a potential setup for a nice deeper sell-off that kind of coincides with historically where we are in terms of the sell in May and go away mantra, where typically we have these big, deep, meaningful sell-offs in the month of May. All right, that's it for a set of charts that hopefully should help you make some good decisions here. If this is my money, piece of advice, book profits on all the winners you had over the last several months. I mean, you've really had a great run here. And remember, nobody ever got fired for taking profit. But mainly, whether this correction happens in May, June, or over the summer, you want to have a sufficient amount of capital in cash so that you're ready to reload on all of your favorite positions when that pullback actually does happen. All right, thanks for hanging out with me. Make sure you give a like to this video. That's going to help the YouTube algorithm as always. Subscribe to this channel if you enjoy this type of content, and I'll see you in a few days.